Vamos a darle la bienvenida a nuestro primer invitado del programa de la extensión del cierre de Wall Street del día de hoy, quien es nada más y nada menos que uno de los mejores analistas global macro del mundo entero. Su nombre es Julian Bridgen y él obviamente está en todos esos canales de televisión. Yo creo que es bien interesante, un aplauso porque comenzamos con esta internacionalización desde América de lo que es la extensión del cierre de Wall Street. Julian, we are very happy to have you. We obviously have to speak with you in English because that's your mother language. But I think the important part for you is to try to explain what's going on from the global macro perspective. And you have different terminology, like qué es el excepcionalismo e indudablemente cómo ves la hiperfinanciación. Y si nos puedes explicar lo que estás observando, sería interesante para todos esos amigos que se nos suman en la tribuna y que están pendientes de lo que sucede minuto a minuto. Muchas gracias.
Pleasure. Thank you very much for having me on the show, Victor. Look, ladies and gentlemen, I think we're at a very important point. Global macro, as I think Victor was saying, is important at inflection points for markets. It generally doesn't play a huge role when markets are trending in long extended phases. It is supportive of those whether they're going up or down. But when the global macro really comes into its own is either at tops and bottoms of the market. And I think we're at potentially one of those points now. I think what we have seen is this period of what's referred to in the markets as US exceptionalism. And Victor's put the slide up here, and what you can see is kind of a virtuous cycle that we've had. And it really started in 2011, but accelerated materially starting in 2014. And what happened then is the dollar started to rise. And in 2014 as well, we had a period where the European Central Bank and the Bank of Japan was moving towards negative interest rates, which is kind of a crazy concept, but they did. And the US was actually tightening monetary policy, the Fed was tightening, and the dollar started to really accelerate. And so that has a natural tendency to kind of suck US or foreign money into US assets, and they pile into US stocks and corporate bonds in particular. Now, that in itself feeds through into the economy, and it feeds through in a number of ways. So as Victor said, we have this thesis that we call hyperfinancialization. Very simply, it is that the equity market leads employment in the United States. And you can put the charts up and play with the graphs yourself, but basically you'll see that it leads by about 6 months. And it's a very simple relationship. When stocks are rising, CEOs are hiring. When stocks are falling, CEOs are firing. So we have this period that as stocks started to perform, CEOs are hiring lots of people. That helps support consumption and helps support employment. And then at the same time, we have another impact, which is it drives the wealth effect. And the wealth effect in the United States as a driver of consumption has never been greater. So the top 10% of American consumers are now responsible for 48% of total consumption. And this top 10% is driven by wealth created from the equity markets. And then finally, as the economy booms, because you've got all this employment and all this consumption going on, we typically get a large current account deficit. So we import an awful lot of goods, and that has to be funded by foreigners. The only people who can fund the current account deficit, as anyone in Brazil might know, is or Argentina, are foreigners, and if they leave, that's the problem. But basically, it sucks in even more money. So you get this sort of virtuous cycle where the money comes in. As the money comes in, it gets invested in US assets. That supports the economy. And this is actually a relationship that George Soros, the famous hedge fund investor, invented called reflexivity. And reflexivity can lead to extreme mispricing in the market because it is inherently, Victor, unstable. And so, as you can see from this graph, it really depends on the dollar has to remain strong because you've poured money into the US in your own currency. You haven't hedged it. You can't hedge it to fund our current account deficit. So you're exposed to exchange rate movements as a foreigner. Secondly, US assets have to continue to outperform because if suddenly one day you wake up and say, I'd rather have my money in Brazilian mining stocks, right? Then the money goes home. And then thirdly, we need an ongoing strong economy to keep physically demanding that that money to fund that current account deficit, because if we go into recession, then we don't need your money anymore and the money goes home. And
Julian, quick question.
Yeah.
Because obviously this is extremely interesting, and a lot of people that are seeing our program today are portfolio managers, up to some point are analysts, but there is also regular people seeing everything because they understand the importance of the capital markets in their own economy and finance. How are you going to explain to this typical person from the middle class, also the people that are seeing us from Spain, which is our headquarters in Madrid, that are basically seeing a little bit of good news where the euro is gaining some sort of value? And I think you were mentioning a couple of weeks ago that you were bullish on the DAX, you were bullish on Germany, and you're seeing now a lot of movement today, perhaps in China. And how are you seeing that, and how do you explain that to the typical average middle-class person that have a portfolio that is concentrated, don't get me wrong, in the U.S., because we've been seeing this into the market for the last 15 years. But do you think that we're going to get into recession? Are you not ruling out what is commonly known as the Trump pot or the Fed pot? Because the interest rate are extremely real, positive, and then basically they have a lot of things to maneuver. Why don't you explain a little bit about that? Because people are extremely anxious, Julian, and I think you can tell them, please.
Victor, look, to your point, we've basically been piling money into the US for, at least the last 15 years, 10, 15 years. And the amount of money that's gone in is ginormous, ladies and gentlemen. There is the series that looks at the difference between the assets that foreigners own in the United States and the assets that Americans own abroad. That has increased in the last decade by $17 trillion. So foreigners have increased their investment, their net investment in the United States by $17 trillion. And increasingly that has gone into the equity market as a share, Victor. So that share is the one that's really grown. There's been some that's gone into foreign direct investment, so building factories in the US, which is exactly what Donald Trump wants, but an awful lot has gone into equity investments. And that is dangerous because it can move quite quickly, that money. So if one day, someone in Spain looks at their portfolio and in euro terms, in the last 3 weeks, if you own the S&P, you're down over 12% in 3 weeks, in 3 weeks. And if all of a sudden you just say, oh, okay, well, if we're going to spend all this money on defense, if we're going to start issuing common euro bonds to strengthen the economy, if we're no longer going to get the protection from the United States that we thought we were going to get, then really I don't want to be invested in the United States. I'm going to bring my money home. Then we have basically $17 trillion of investment, net investment flow that could unwind. And even if just 20% unwound, Victor, the movements would be enormous. And when you look at long-term technicals that we like to do, you can see that for the first time since 2008, Europe has broken, in euro terms, out against the S&P. So Euro stocks are outperforming and have broken significant trend lines. And I think we are truly at a historic inflection point in terms of what the Trump administration is trying to do. I don't think people understand that, Victor, but I think also in terms of markets. And I think my concern is this process will not be smooth, It would be nice to think that we can just gradually pull money out of the US and allocate it into emerging markets, which tend to do well when we have a weak dollar. I think it would be nice to think we could put it in Europe, but I'm sure you're familiar with the game Jenga. Absolutely. And I'm afraid at some point we're going to pull too many blocks out of the US of cash, and this thing will drop. And in the process of dropping, it will be the worst market because that's where the money is being removed. But most things will drop in that scenario. Even Europe may go down. It may go down less than the United States. I would suspect it would go down less than the United States, but it will go down.
Julian, quick question then, because basically we're going to try to bring you in the next 30 days to validate your little bit bearish outlook. Tell us about gold, or what are the best trades that you're seeing where the money is going, let's say, for the next 3-4 weeks. Statistically speaking, Julian, and you can correct me, around the tax day, mid of April, you see the markets coming back. I don't know if that is a sensation that you see when you see, statistically speaking, few things. But I don't know if you can tell the audience your best trades for the next 30 days. I know you are advising, just so that people know, you are advising major portfolio managers for big hedge funds, and then you are speaking with them at a global macro level. So if you can tell our audience best trades for the next 30 days, what you will do.
It's kind of, look, as you said, we've been long the euro against the dollar. We've been short German bonds. We don't really trade stocks that often, but we did highlight to people that there was extreme pessimism in Europe back in February, and we liked those markets. The problem right now, Victor, is we've seen some quite big moves. They've moved quite a lot already. So I can't say to you, I still like those trades. I think those trades will continue to extend. I can't say that I would be committing new capital to them, particularly at this point. I do think at some point we're going to get a hard bounce in the US equity market. I think that's an opportunity to sell. I do not believe this is an opportunity to buy. I think that when you look at the big institutional, not so much the hedge funds account that I talk to, but the real money players, so the big pension funds, I think these movements have been so rapid that they haven't even really had a chance to initiate their movements. And I suspect that even if you do get a retracement, let's say, today's classic action in the US equity market, right? We get a squeeze at the end of the day, and then it gets sold off. And I think if you look at the currency markets, and it's this interaction which is very important, Victor, it's incredibly unusual, sir, to see the dollar weaken as stocks weaken. The typical reaction is that you flow into the dollar in a risk-off environment. But the reason that we're selling the dollar is because the risk-off environment is occurring in the United States, and the world is long US assets. So as they sell those US assets, they take them home. So I think those are the trends we play. But right here, right now, I think it's a little tough. But I'm a buyer. I'm a seller of a dollar on the rally, be that against dollar yen or the euro. I am a seller of US stocks on the rally. I believe we have hit definitively peak US exceptionalism. And the things that I want to buy, though I really want to buy, I'm a super bull, as you know, on gold. Victor, we've been long for a very long time. But even that, I'm a little worried, because if we get a broader risk-off environment, that is going to shake all sorts of portfolios, and gold is part of people's portfolio. I don't think it goes down very far, but I would buy that dip. I'm really desperate to buy silver. It tends to be more of a metal that does well once you get through the pain, right? It tends to do well in a positive inflationary, reflationary environment. So when the dollar is weakening and the Fed is cutting, that's when silver really comes into its own. And I want to own some base metals, but though, once again, you need to go through that typically pain period, Victor.
Thank you, Julian. Listen, I appreciate everything you're explaining us. You mentioned to go long the dollar. Para los que hablan español, él dice que debemos ir largo el dólar, la plata, indudablemente vender en cada uno de esos rallies que vamos a tener. Julian, thank you very much. We have another of the analysts for an Interactive Broker on the backstage. So thank you. We'll visit everything with you within the next few weeks. Thank you very much.